Good morning. I'm Bart Rekucki, an analyst at Gabelli Funds. Today I'm discussing an intriguing opportunity in a stock that we believe has multiple avenues to surface value. Donnelley Financial Solutions, the ticker is DFIN or DFIN, has 29 million shares. The stock is at $39 for a $1.1 billion market cap with $150 million of net debt for a $1.3 billion total enterprise value. DFIN was spun off from RR Donnelley in 2016 in a tax-free separation and is a major player in the market for financial reporting and compliance tools. DFIN is the number one player in SEC EDGAR filing tools for corporations with about 40% market share among the Fortune 500. The tools help companies prepare 10Ks, 10Qs, 8Ks, and other filing documents for the SEC. DFIN is also the number one filing agent for fund companies. About 80% of the top 50 fund complexes use DFIN to file their shareholder communications and SEC documents. Since DFIN spun off, the company has done a fantastic job over the past 6 years of transitioning from a legacy print business to a tech-forward software business. In 2016, 40% of revenue was from low-margin print, while only 14% of revenue was from higher-margin software business. Now, the company has outsourced the print operations and generates nearly 40% of revenue from software, just 20% from print. The company's EBITDA margin has gone up substantially as a result, going up from 15% to 26% during this time. This transition has been aided by regulation, a trend that we expect to continue. First, in 2021, the SEC adopted Rule 30e-3, which allowed funds to send their shareholder communications digitally rather than in physical form. This helped to push customers towards higher margin software and away from print. Second, in 2024, the SEC is adopting the Tailored Shareholder Reports Rule. This will require funds to send a visually appealing 3 to 4 page report twice a year to shareholders. Additionally, it's adding a requirement for the funds to send a report for each share class. The average fund has 2.5 share classes, so this will help DFIN because customers will have to send more reports. Management has also done a fantastic job of capital allocation over the past few years, first taking leverage from 4 times debt to EBITDA in 2016 at the spin to under 1 times by the end of 2021. In fact, DFIN was actually able to use debt to add $100 million to their share repurchase in 2022. DFIN has now decreased their share count by 5.4 million shares, or about 16% of the total since the end of 2019. Looking forward, we expect management to be aggressive in looking to surface value, as the stock right now is at a low valuation of just 10 times PE and 6.5 times EBITDA. We expect DFIN to generate about $870 million of free cash flow in the next 5 years, with the majority of this going towards share buybacks. With a current market cap of just $1.1 billion, that would be over 70% of the market cap that the company could buy back with their free cash flow. Additionally, the company could look to add debt to accelerate these repurchases. 3 times leverage would be pretty reasonable, and this would allow for $450 million of additional debt capacity with the proceeds going towards share buybacks. Finally, DFIN is an attractive takeover target. Strategic buyers, including SS&C and Broadridge, have a history of acquisitions in the 10 to 13 times EBITDA range, well above DFIN's current 6.5 times multiple. Private equity has also made purchases in a similar multiple range. Our model suggests that if PE paid 10 times and then sold the company for the same multiple in 5 years, it could make a 23% IRR. We view multiple avenues for the company to continue to surface this value, and at this price, we find shares attractive.